So as I was saying, since it's week 4, one of our activities is the video discussion number 1. Go ahead and view the video, submit your main post of at least 100 words in length, and reply to at least 2 other students. Make your replies at least 3 sentences in length each. And then get that all submitted this week by Sunday so that you get full credit for this activity. All right, any questions on the video number 1 discussion? Another activity we have this week that is new is the Personal Progress Journal. This is an extra credit opportunity. And to receive full credit, you're going to post this week. You'll also post before the end of week 8, and then one more time before the end of week 12. And in each post, what you do is you just summarize how the course is going for you, any challenges you're experiencing, any discoveries you've made, or things that you've learned that you find useful. So just comment on your experience in the course. Only you and I have access to the journal. So I will read your post, I will provide some feedback. And again, if you do submit all 3 posts, then you get a full extra credit point. All right. So you have those 2 activities to work on in addition to our normal exercise set, problem set, and chapter quiz. The other thing I wanted to go over real quickly is there's a banging noise out there. I don't know if you can hear it. This announcement here, there are 3 upcoming activities in case you're interested. Our Dean of Career Technical Education, which is the department that business falls under, has a newsletter he's sending out to the different businesses that support Hartnell College with donations and who hire our employees. So he's starting this newsletter and he wants to spotlight some students each time. So if you would be interested in being one of those students, you can fill out this survey here. You'll probably be asked for a photo at some point, or maybe they'll take a headshot of you. They'll ask you some questions about your experience at Hartnell College, and then that will go into the newsletter. So that's not a bad thing to be able to have as an experience, help promote the college, but at the same time, you can put that on your transfer application as something that you did, or maybe even on your resume. Say that you were featured in the college newsletter. Another opportunity is the Integrated Thinking Challenge coming up in March. So if you're interested in that, it's the 2nd conference. Last fall was the first one, and it was online. This one is going to be in person. It's tentatively scheduled for March 17th, which is St. Patrick's Day. And we're looking for students who can help lead the conference. So you would help plan the conference. It's already in the planning process, but you would assist with that. And you would help facilitate on the day of the event in one way or another. So, that doesn't necessarily mean you facilitate the discussion, but you could if you wanted to. You might facilitate by helping keep track of attendance, or who knows. So if you're interested, there are funds to actually pay students to help with this process. If you're interested, you can let me know. And what the conference is all about is it brings together students, faculty, business leaders in the local area, and especially artists as well as scientists, for the purpose of consulting and coming up with ideas of how to improve our communities in the areas of healthcare and economics, the environment, and education. So you get to pick one of those 3 areas that you will be involved in and help come up with some ideas and maybe even implement. Last time when the conference happened in the fall, I was in the education group, we came up with some ideas to develop some new internships to help students get experience out in the real world. I've been working with some different organizations trying to get some of those internships off the ground. Plus, we have other internships that are already going. So that's just an example of how, this conference can lead to actual action. The third area of opportunity, if you're interested, there is a Dungeons and Dragons club on campus. A student who was previously in some of my classes started this club, and they're looking for, they're looking for new members in general, but they're specifically looking for a member who can serve on the Interclub Council. So if that is something that interests you, basically you would represent Dungeons and Dragons Club on this council where representatives from all the clubs come together to talk about club-related issues. So if you're interested, scan the QR code and you can provide your information and the club will be in touch. Again, this is something that could go on your resume or your transfer applications. So those are 3 different activities if you are interested. All right. And welcome, Juan and Jane. I think I've covered everything. Oh, except this. I wanted to let you know for chapter 4, there are some accounting stuff videos. So if you scroll down to chapter 4, you'll see accrual related videos, deferral related videos. Those are the main concepts in chapter 4, accruals and deferrals. We'll learn about what those are. They apply both to expenses and to revenues. It does get a little confusing sometimes, so these videos might help. All right. Are there any questions before we get into our exercise set? Okay, then. Well, let's see. How many exercises do we have? We have 14. This actually should go fairly quickly. I think we will have some extra time today. So if questions do come up, let me know. We'll have time to address it. And we might even finish early, knock on wood, and we'll see. Okay. So the first exercise, identify whether each of the following transactions are related to revenue recognition, or which are related to revenue recognition, are accrual, deferral, or neither. Okay, so I guess I better give you some background. This chapter is on the adjustment process. We learned about the first 4 steps in the accounting cycle already, which is that you identify and analyze your transactions. That's step 1. Then you post them to the journal based on your analysis. In other words, you say, oh, okay, this is a debit to cash, and this is a credit to revenue. So based on that analysis, you post it to the journal. Then you post your transactions to the ledger, which are the individual accounts. Then you make your unadjusted trial balance, where you take the balance of every account, you list it on the trial balance in the appropriate order: assets, liabilities, equity accounts. Some of them will have debit balances, some will have credit balances. You add up your debits and credits, and they should balance, they should equal. So those are the first 4 steps, right? We focused on that last week. Now we're learning steps 5, 6, and 7. Step 5 is you have to make adjustments to some accounts. The reason for that is that we mostly do accrual-based accounting, which means that we count our sales when we provide the product or service, not necessarily when we got paid by the customer. And we count our expenses when we incur the expense, not necessarily when we paid for it, right? That's accrual-based accounting. So what that means is sometimes we have to later make an adjustment. And that's what this whole chapter is about, the adjusting process. This is step 5 in the accounting cycle. After we make our adjustments, Then step 6 is we make another trial balance, and this is now called the adjusted trial balance because we've already made our adjustments. And then we make our financial statements, which is step 7. And we've done some of that already. So really the main thing we're going to have to learn is how to make these adjustments. And adjustments come in 2 varieties. There are accruals and there are deferrals. Accrual is something that builds up, and a deferral is something that is basically postponed until later. And because of that shift in time in either case, we have to make an adjustment later. So for example, if a customer pays us for work we haven't done, well, later we're going to have to do the work. So when we do that, then we make an adjustment. Okay, so that's what we're learning about in this first exercise. These are all related to revenues, and we have to figure out which is an accrual, which is a deferral, and which is neither. Now, there's a little mnemonic device that I came up with. I don't know if anyone else has ever come up with it, but I find it helpful, so I'm going to share it with you. In an accrual, the action happens first. So if you think A for accrual, A for action, okay? And you can remember. And in a deferral, the dollars change hands, or I'll just say the dollars happen first. Okay, so that's the way to figure out which is which. If the action and the dollars happen at the same time, or at least in the same period of time, then it's not an accrual or a deferral. It's just a regular transaction. But when they happen in different times, either the action happens first, the deferral is in the next period, that would be an accrual. I'm sorry, the action happens first and the dollars are in the next period, that would be an accrual. Or the dollars happen first and the action happens in the next period, that would be a deferral, okay? So with that in mind, A says sold goods to customers on credit. In this case, we made a sale. That was the action. Have the customers paid us? No. It says on credit. That means the customers are going to pay us in the future. So the dollars are coming later. So we know that this first one is an accrual. I'm just going to put an A for accrual. Okay, because the action of the sale happened in this period. The dollars are coming later. B says we collected cash from customer accounts. Okay, so B is really the second part of what happened in A, right? In A, we made a sale, but the customer didn't pay us. In B, now the customer is paying us. So it's really just the second half of that first transaction. So we're going to put that this is neither an accrual nor a deferral. Okay. C says we sold goods to customers for cash. Okay, we sold the goods, that's the action. We got cashed, that's the dollars. They're happening in the same period, so this is also neither. And the last one, we collected cash, that's dollars, in advance for goods to be delivered later. So we have not provided the goods yet. So the revenue is deferred in this case, right? We got paid, but we can't count it as revenue until we do the work in the future. So this is a deferral. Any questions on this first exercise? All right. Number 2 is similar, but now we're looking at expenses instead of revenue. It's the same concept. We have to see which happens first, the action or the dollars. We paid an expense for the current month, okay? So the dollars happen in this month and the expense happened in this month, so this is neither. We prepaid an expense for future months. Okay, so the dollars happen now, but the expense hasn't happened yet, right? We paid for it, but we haven't actually incurred the expense. So this is a deferral because the dollars happen first and the action's happening later. Just type it out. Okay, the next one says we made, and I spelled it wrong. There we go. We made a payment to reduce accounts payable. Okay, here we're just paying down debt that we already have. So this is not a deferral or an accrual. Okay, this is, again, it's the second half of a transaction. The first half was when we made the purchase and didn't pay. Now we're just paying what we owed. So this is neither. And the last one, we incurred a current month expense to be paid next month. Okay, so the expense is the action. We incurred that expense. We haven't paid for it. In fact, we're not going to pay until the next period. So this is an accrual. Action happened first. Any questions? Okay. In this case, we have to look at, is it an accrual or a deferral, and is it revenue or an expense? Starting with rent paid in advance for use of property. Okay, what would that be? If we've paid for rent, but we haven't used the property yet. Might help if I copy this mnemonic device down for us. I'll put it right here. Any guesses? Rent paid in advance. Is that an accrual or deferral? If we paid in advance, so the dollars already happened, right? And the action of actually using the property is going to come later. So this is a deferred expense. B, cash received in advance for future services. Okay, so the dollars have happened and we're going to complete the action of providing the services in a future period. Any guess on this one? So this is deferred revenue. It's deferred because the dollars happen first, and it's services that we'll provide in the future, right? That's revenue. Okay, C, a bill received for utilities expense. So we got a bill. It tells us how much we've used in utilities. So that expense has already happened, but we haven't paid for it yet. So we're going to pay for it later. So the action of the expense has already happened. The dollars will come later. So this is an accrued expense. And the last one, fees earned but not yet collected. So we did some work for a customer. So we've earned some fees, but they haven't paid us. The dollars are coming later. This is accrued revenue. Okay. Questions on exercise 3? All right, we'll move on to 4. Oh, okay, this is a little different. Here it's asking us what are the accounts that are associated with these accounts. Now, if you've watched the recorded lecture or you've read in the textbook, you might already know this, but if you haven't, you would have no idea. So I'll explain it to you. Salaries payable goes with salaries expense. The reason for that is at the end of a payroll period, the payroll processor takes a look at how much is owed to the employees. So you figure out what the expense is, for their salaries if they're paid salary, or for their wages if they're paid a wage. Okay, so you would look and see what is the total expense for salaries. But oftentimes the company doesn't actually pay it until later. So you might look at the salaries expense for January, and then you pay that in February, right? A lot of times there's a delay of at least a couple days, maybe even a week from the time the payroll is, from the time the payroll period ends until it is actually paid out by the company. So the way you would journalize it is it would be a debit to salaries expense, a credit to salaries payable, and then when the company actually makes the payment, you would debit salaries payable because that then goes away, and you would credit cash because that's how you paid the employees. Okay, so salaries payable and salaries expense, they go together. Then we've got depreciation. That's come up a little bit. We have a chapter in the future with long-term assets where we'll go into detail on depreciation. But for now, the way we journalize depreciation is we debit depreciation expense, we credit something called accumulated depreciation. All right, so this is how this works. If you have a long-term asset, let's say a building, you can't count the whole cost of that building all at one time as an expense. The IRS won't let you do that, because then companies would always be making these huge purchases because they'd be able to save a ton of money on their taxes. So instead, when they make a big purchase on any kind of long-term assets, they have to take the cost of acquiring that asset and they have to expense that over the expected life of the asset. So if we've got a building we buy for, let's say, $3 million, and we're planning to use that building for 30 years. So what does that come out to? $100,000 a year, I think. Whatever the math is, doesn't really matter. So the way you would journalize it is every year you would take that much depreciation, you would debit depreciation expense and credit accumulated depreciation. And then after the entire period has gone by, you would have fully depreciated that asset. Okay. Remember that the cost of that asset remains on our books as the value of the asset. So if it were a $3 million building, it'll still say $3 million in our building account for that building. But there will be an accumulated depreciation account for that building of $3 million. So if we want to see what is the book value, we would say original cost minus the depreciation, and the difference would be the book value. The reason that's important is then if you sell the asset for more than the book value, you have to pay taxes on that gain. And if you sell it for less than the book value, that reduces your taxes. So that's why we even have to be concerned with that. So what you need to remember here, depreciation expense always goes with accumulated depreciation. Okay? Then we go to C, supplies. Supplies goes with supplies expense. And the way this works, when you buy supplies, imagine you've got an office with, staplers and paper and other office supplies. So you buy those supplies, that's an asset. Okay, whether you've paid for them already or not, they are an asset that you now own. When you use them, they become an expense. So once they've been used, your supplies goes down. The value of your supplies goes down, and your supplies expense goes up. That asset of supplies is becoming an expense because it got used. So those accounts go together. And the last one, it says unearned rent. Basically what they mean is if we got paid money from a tenant before the tenant used the property. So we haven't earned it yet because the tenant hasn't used the property, right? So we did not earn that rent, but we collected the money. So we would call that unearned rent revenue. Let me just go ahead and add revenue here. However, once the time goes by and the tenant has used the property, that unearned rent revenue goes away and we now credit rent revenue. So unearned rent revenue goes with rent revenue. Okay, so these are 4 very common adjustments. You'll be seeing these again, and now you know which account goes with which account. It's probably confusing at this point, but hang in there. It'll make more sense as you get experienced. Any questions on number 4? All right, so number 5. This company bought an insurance policy on August 1st. August 1st, okay. It was a $6,000 policy for 1 year. Now, companies' fiscal calendars, the period in which they do their financial accounting, doesn't necessarily have to start in January. It could actually start in any month. Whatever the company decides. So if the company decides they'd rather start their fiscal year in March and then it goes through February every year, that's fine. That's their fiscal year. And then once their year ends, that's when they would produce their annual reports and pay their taxes that are due at that time. So your fiscal calendar does not have to match your actual, the calendar year. In this case, though, let's just say that the company does have a standard calendar year as their fiscal year. So their year starts January 1st, goes through December 31st. They buy this insurance in August, on August 1st. Okay, so now they have insurance that they're going to use part of it this year, and part of it's going to carry over into next year, right? It's going to go from August of this year into August or until July 31st of next year. So we have to then account for that. If it's a $6,000 policy, we can't count all the expense at one time. It's kind of like depreciation. We have to spread it out over time. So we take that $6,000 insurance cost, divide it by 12 months, and that's $500 of insurance expense per month. Now, some companies might every month add a $500 insurance expense in their books and decrease their prepaid insurance by that $500 every month. In this company's case, they didn't do that. They waited until the end of the year, December 31st, and then they had to see how much of our insurance have we used. That $6,000 of insurance, again, is $500 per month, right? As of December 31st, they've had August, September, October, November, and December. So they've had the insurance for 5 months. 5 months times $500 per month is $2,500. So what they have to do is now count that as an insurance expense for those 5 months. And they have to reduce their prepaid insurance, which is an asset that has now gone down because they used 5 months of it. Okay, so they still have the rest of the prepaid insurance. They still have $3,500 worth. That'll cover January through July 31st of the next year. All right, so this is an adjustment to account for that use of a prepaid asset. So this is what the journal entry is going to look like. And by the way, it doesn't make a difference if they've made any claims on their insurance policy or not. Just the fact that they had the policy for that period of time is what I mean when I say they used it, right? Because you get insurance to cover you in case something goes wrong. So even if nothing goes wrong, you still have the insurance, right? And time goes by, so it gets used up. Okay, so that's our journal entry. We also have to fill out the ledger. And the ledger is the individual accounts. In this case, it's the prepaid insurance account. So imagine that this is our T account, okay? So we have debits on one side, credits on the other. At the beginning of the year, they had 0 prepaid insurance. On August 1st, they bought $6,000 worth. So there was a total of $6,000 of insurance in the insurance account at that time. However, by the end of the year, they had used $2,500 worth. See this credit to prepaid insurance in the journal? That would get copied down to the ledger as a credit. So then we take our previous subtotal, subtract the insurance that got used. What's left over? That is the $3,500 of insurance that remains. Okay. Any questions on exercise 5? My voice is getting a little scratchy. I apologize for that. Let me take a sip. Okay, moving on to number 6. This is what happens when I have 3 classes in one day, which is my Tuesdays and my Wednesdays right now, which I don't mind. I'm not complaining. I actually love my job. But my voice does tend to get worn out. Okay, so moving on to exercise 6. This one is similar. Here we've got an attorney. Sometimes attorneys charge what's called a retainer. A retainer means you pay them in advance for future work. So they collected a $5,000 retainer for future legal services. During the period, they did $3,500 of those services. There was no beginning balance at the beginning of the period. And so we have to make the December 31st adjusting entry. Okay. When we first collected the $5,000, we got the cash. So that would be a debit to cash, but we hadn't done the work yet, right? And if we haven't done the work, then it's unearned revenue. Now, attorneys charge a fee for their services, so we could call it unearned fee revenue. And that's what we're going to call it in this case. Now, that would have been the original transaction. Now, what we're doing is at the end of the year, $3,500 of that unearned revenue has now been earned, right? So we are debiting unearned fee revenue. It's decreasing by $3,500. Anybody know what account we would credit?
Service revenue? Fee revenue, sorry.
In this case, they're calling it fee revenue. Some companies would call it service revenue. So that is just a matter of preference. But yes, that is the right idea. The unearned revenue went away because the actual revenue, now that the service has been provided, the actual revenue has occurred. Then if we go to the ledger, like we did in the last exercise, at the beginning of the year, they had no unearned fee revenue. Then they collected that $5,000, so then they owed $5,000 worth of work. If we add those together, we get our subtotal, $5,000. Then we earned $3,500, right? So this debit to unearned fee revenue gets copied down here to the ledger. And we subtract that to see what is our balance. In unearned fee revenue, it's $1,500. Okay, any questions? All right, moving on then to number 7. Reviewing payroll records show that salaries are due to be paid on January 3rd, $3,575, but this is work that was done in December. So the expense was actually from December, and it's going to be paid for in January. There was no previous balance in the salaries payable account. And we need to make the December 31st adjusting entry. Okay. So what we're doing is on December 31st, we're saying, okay, our salaried employees have earned $3,575. So that is an expense to us as a company. But because we have not paid it yet, we have salaries payable. Okay, and this is what I was saying earlier, salaries expense goes together with salaries payable. The action of the expense has happened, the payment has not, so that's going to be in a future period. Then when we actually pay the employees, the payable goes away and cash goes down. All right, that's all we have to do for exercise 7. So let's move on to 8. Okay, looks like this one is straddling across 2 different pages. So let me move this down. Okay, number 8. Supplies were purchased on January 1st for $8,500 in cash. On December 31st, we did a physical count, and we saw that we still have $1,200 of supplies. Okay, that's the value of the supplies that are remaining because they have not been used. No beginning balance in the supplies account. So the first thing we have to do is the original transaction when we purchased the supplies. That's A. When we purchased the supplies for cash, what would we debit and what would we credit?
Supplies will be a debit and cash will be a credit.
That is exactly right, Jane. So our supplies went up. When an asset goes up, we debit it. Our cash went down. That's another asset. And so we credit. Perfect. Okay. Then at the end of the year, we go and we look and we see that we only have $1,200 worth of supplies left. So now we have to make our adjusting entry. What amount do we need to put here in this entry?
7,300.
That is exactly right. Okay. So we started off with $8,500 worth of supplies. At the end of the year, we had $1,200 worth. So we must have used $7,300 worth of supplies, right? That's the difference. You have to be a little careful in this chapter because sometimes they'll tell you the amount that was used. Sometimes they'll tell you the amount that was left over. So don't get those mixed up. Okay, we had a $7,300 supplies expense because that's how much got used. And our supplies have decreased by $7,300. Then if we go to the ledger, we had 0 supplies at the beginning of the year. We bought $8,500 worth. So that gave us a total of $8,500 worth. We used $7,300 worth, and that left us with $1,200 worth. Okay, makes sense? All right, number 9. Okay, we're doing journal entries. So the first one, again, we bought supplies for cash. Well, that's easy. We just did that, right? So supplies go up and we credit cash because it's going down. Then at the end of the year, we see we have $800 of supplies left over. So we have to take the original amount of supplies, subtract $800 to see the amount of supplies that got used. Supplies go down, so they get a credit of $3,050. And because they were used, that is a supplies expense. Any questions on number 9? All right, then moving on to number 10. Okay, we have insurance that expired this period. So for insurance to expire, that means we must have paid for it before it got used. That's the way insurance generally works, right? If you bought an insurance policy for just 1 month, then you would pay for it in the same month that it would expire. But normally you're paying for a year at a time. So we call this prepaid insurance. And as it expires, that asset of prepaid insurance goes down. So we would credit prepaid insurance. What account would we debit in this transaction? Any guesses out there?
Insurance expense.
You got it. Insurance expense, right? We used $18,000 worth of our prepaid insurance, so now we can call it an insurance expense. B is depreciation. That is always going to look like this for the entire semester. It does change when you get to managerial accounting, but in financial accounting, you always journalize it. Depreciation expense, that gets a debit. Accumulated depreciation gets a credit. Now, this does take a little bit of explanation. Obviously, depreciation expense is an expense, right? So when that expense goes up, you would debit it. Accumulated depreciation is where you keep track of how much that particular asset has depreciated. So it accumulates over time until you fully depreciated the asset. Now, the part that's kind of weird here is this is actually an asset type of account. Accumulated depreciation is an asset type of account, but it decreases the value of our assets. Kind of like the way expenses are equity accounts, but they decrease our equity. And dividends are also equity accounts, but they decrease our equity. Accumulated depreciation is an asset account that decreases our assets. So we record it on the credit side because, as we know, assets go down on the credit side. Okay? So that's how accumulated depreciation works. It's what's called a contra asset account because it works opposite of the assets. All right, any questions on that? Okay, the last one, C, says salaries earned by employees but unpaid. So we have a salaries expense and we haven't paid it. So that would be salaries payable. Okay. All right, 11, journal and adjusting journal entries. Oh yes, okay, I remember what's going on here. So this is our unadjusted trial balance. Okay, it's a very short one. This company has an asset account, fixed assets. They have the contra asset account, accumulated depreciation, and you see how that has a credit balance. So we have our assets and our accumulated depreciation. Our net assets then, well, actually prepaid rent is also an asset. So our total assets would be $138,000 minus the accumulated depreciation. Okay, just for reference. And then we also see we have a liability account, unearned revenue. So what we need to do here is post the adjusting entries. The first one is depreciation on our fixed assets. So time has gone by and we're going to take $8,500 of depreciation. Again, the way we do that is debit depreciation expense, and we credit accumulated depreciation. Okay, that's not too bad. For B, it tells us unexpired prepaid rent. Okay, so we had prepaid rent, some of it has expired. The unexpired prepaid rent is what is still remaining. So if we had 18,000 worth and 12,500 is still remaining, the difference, 5,500, is what has expired. Okay, so that's what we have to count as our rent expense, and it reduces our prepaid rent by 5,500 because it expired. The last one is similar here. It says remaining balance of unearned revenue is 555. Okay, there was $3,500 worth, right, of unearned revenue. Then 555 remains, so 2,945 is what has expired. So that's how much our unearned revenue goes down, and our revenue goes up, right? Because unearned revenue is a liability that has gone down because we did the work, and revenue is an equity type of account that goes up because we did the work. It's a little bit confusing. I hope it makes some sense. Any questions on exercise 11? All right, well, let's move on to 12 then. Okay, prepare an adjusted trial balance. So this is actually pretty easy here. We're just going to take all the data from the account balances in the ledger, and we're just going to move it over to the proper place. So cash goes to the cash place, and assets have debit balances with the exception of accumulated depreciation. So these are all debits. Accounts receivable, as you'll recall, is an asset because that's money that our customers owe us. So it's like an IOU that we have. $8,800. Here's prepaid insurance. That is an asset because we own what we've paid for. Once we use it, then it becomes an expense. Okay, so these are our assets. Accounts payable is a liability that has a credit balance, right? Common stock is an equity type of account that will have a credit balance also. Service revenue is another equity type of account that has a credit balance. Administrative expense is an equity type of account that has a debit balance. Remember deal, dividends, expenses, assets and losses, increase on the debit side, and have typically debit balances. Okay, so now that we've created our trial balance here, we can add up our debits and make sure they equal our credits. So if I did that right, I got 99,600 on the left. That looks right. $99,600 on the right. Okay. So there we go. We are in balance. So making a trial balance isn't too hard. On this one, they are throwing in a little wrinkle for us. They've given us the data, but we have to make a couple adjustments. Now, normally the adjustments you would make in the journal, then you'd copy that information to the ledger, you'd update the balance of the accounts in the ledger, and then you would make your trial balance. But in this case, they're having us make these adjustments directly into the trial balance. Okay, so this is just for practice. It's not something you would normally do. Let's start by copying down the data from up here, and then we will make our adjustments. So accounts payable goes right here. Accounts receivable, that's an asset, that goes up here. Administrative expenses are down at the bottom. And we have cash, that is an asset, that'll be up at top. Common stock, that's equity, that's in the middle. Prepaid insurance is an asset. Service revenue, that's also in the middle. Oh, towards the end. Okay. All right. Now notice there is salaries payable here. We didn't have salaries payable in the data, but we will after we make an adjustment. So let's do that. The first adjustment is we owe some salaries to some employees, $2,000. Okay, so that is our salaries payable. And remember, salaries expense goes with salaries payable. So when we do this adjustment, we would debit salaries expense. If we look at these accounts, we don't have salaries expense. So we're just going to put it in here as part of administrative expense, okay? I think it would make sense to have a separate account, but for this example, they want us to just put it together. Okay, that's fine. We're lazy accountants. We'll just do it that way. I'm not calling you lazy. I'm just saying, you know. I guess that's why we're doing it that way. Then insurance that has not expired is equal to $12,000. Well, here it says our prepaid insurance is $16,000. So it's gone down to only $12,000. So we're reducing our prepaid insurance by $4,000. Okay, so we could think of that as a credit to prepaid insurance, because if we had 16,000 here and we had 4,000 here on prepaid insurance, well, we could simplify that, right? And say, oh, well, that is equal to 12,000 on the debit side, right? Because in the ledger, we would take 16,000 minus 4,000 equals 12,000. So we reduced our prepaid insurance by 4,000, but then we have insurance expense. That's also going to be in the debit column. Again, we don't have a place for insurance expense, so we're just going to add it here under administrative expense because I'm being a lazy accountant. And so I added here, we're now up to 60,800, okay? So we reduced prepaid insurance by 4,000, increased administrative expense because it includes insurance by 4,000. So we should still be in balance. Let's add up our debits. Okay, 134,700. Let's add up our credits. Also 134,700. Okay, so that one was a little difficult because we had to make those adjustments, but it came out okay. Any questions on this exercise? All right, so this is our last exercise, and then we've got a couple problems. I think about 5 problems actually. And it's only 5 o'clock, so we're doing well on time. Okay, so here we have an adjusted trial balance. Yay, the adjustments have already been made for us. And this is our adjusted trial balance. What we have to do is make an income statement then a retained earnings statement, then a balance sheet. Because remember, this is the order you would do things. Step 5 is you make your adjustments. Step 6, you make your adjusted trial balance. Step 7 is you make your financial statements. Okay, starting with the income statement. So we're going to need revenue. This company has only one revenue account. And because I'm a lazy accountant here, I have only one expense account. So we put revenue minus expenses, and let's see what we get. Our net income is $18,200. Okay, our income statement is complete. Now we can make our retained earnings statement. Let's see, it doesn't show any retained earnings. So we must have 0 retained earnings to start with. So our beginning retained earnings is 0. Our net income, we just calculated on the income statement, right? 18,200. If that were a loss, we would be subtracting it from our beginning retained earnings. But since it's a gain, we're adding it. Well, I shouldn't say gain. It's not technically a gain. Since net income is a profit, we're adding it. Then dividends. Dividends reduce our retained earnings. Welcome, Maria. Now, if you look here, we don't see any dividends, right? There are no dividends in there. So that is also 0 in this case. Okay, so we have our beginning retained earnings plus our net income minus our dividends of 0. That leaves us with an ending retained earnings of 18,200. Now we have a completed retained earnings statement. And if there are no questions, we will now make the balance sheet. That is assets, liabilities, and equity. So we can go up here. We have our 3 asset accounts for this company. I'm just going to copy and paste because, again, I'm being a lazy accountant today. And we can add them up to get our total. I got $68,100 is our total assets. Then we'll do our liabilities. We have 2 liability accounts. We have accounts payable and salaries payable. Together, they come out to $24,900. Then equity accounts. Our equity accounts are going to be our common stock and our ending retained earnings, which again, we don't see here. So we put in the common stock. Where do we get that ending retained earnings? Remember, it was on the retained earnings statement, right? Okay, so you have to be careful. Sometimes in the data that you're given, there will be beginning retained earnings. Remember, when you create your balance sheet, you're creating the balance sheet for the end of the period. Notice it says December 31st, so it's for the end of the year. So you don't want the beginning retained earnings, you want the ending retained earnings, which comes from here, the end of the retained earnings statement. Okay, now notice back here, we also had revenue and expenses, but we don't need that on the balance sheet because that went on the income statement. The net income from the income statement went on the statement of retained earnings, and the ending retained earnings went on the balance sheet, right? So we don't need to do anything else with revenue and expenses. What we do need to do is add together these two equity accounts. And remember, common stock, that is what the investors have invested into the company. They gave us money or some other assets. We issued common stock. So that common stock represents the value that came from the investors. Retained earnings is the profits of the company that we have not given out in dividends, but have retained within the company. So together they make up the equity, the value of the company, the part that came from the investors and the part that came from the company's profits. So we add these two together, we get 43,200. Now, if we add our liabilities to our equity, we get 68,100. So our assets are equal to our liabilities plus equity. Our balance sheet is in balance. And we're done with the exercise set. Okay, any questions? All right, well, let's go to the problem set then. Oh, I just remembered, I wrote down here, these are the problems we're going to do. Come on. Sometimes my cursor just disappears. It's there, but I can't see where it is for some reason. I don't know why. It's probably me. Okay, let's go to the problem set, chapter 4. Starting with problem number 2. Okay. If you viewed the recorded lecture, I might have covered this in the recorded lecture, but let's go ahead and go through it together here. All right, so we've got these 5 transactions. We need to look at these transactions and figure out what impact did each of these have on cash, if any, and what impact did they have on net income, if any. And remember that because we do accrual-based accounting, net income can go up because of revenue or down because of expenses, even if there were no dollars changing hands. So the first transaction is we paid a balance due for accounts payable, $6,900. So we owed money to some suppliers, we paid them $6,900. What's the impact on cash from this transaction? Could we say cash went down by $6,900 because we paid it out? Now, what was the impact on net income from this transaction? And the answer is there isn't any. This is from a previous purchase, right? At the time we made the purchase, or depending on what it was, maybe at the time we used whatever we purchased, that's when the expense occurred, right? When we pay for it, that does not impact net income. It's the expense that impacts net income. Paying for it impacts our statement of cash flows, but not our net income. So there's no impact here on net income, okay, from making the payment. The next one says we charged clients for legal services provided. In accounting, when we say charged, that means we billed them or we invoiced them. Okay, so we told them that they owe us the money. It doesn't mean we charged their credit card or their debit card. So in normal non-accountant speech, when we say, go ahead and charge my card, we're meaning go ahead and take the money out. But here, where it says we charged clients, it just means we billed them. Okay, so if we billed them, that doesn't mean that we received any cash, right? So there's no impact on cash by just billing them. However, is there any impact on net income if we bill them for services that we have provided? What do you think?
Yes, because it goes to revenue.
Exactly. That's right, Jane.
Yes. So that will increase our net income?
Yes, yes, exactly. The revenue will increase our net income. So because we've provided the service, we can count that as a sale and our net income goes up. So in this case, it's going up by 5,200. Okay, even though we didn't receive any cash. C says we bought some supplies on account. Well, okay. We bought some supplies on account 1,750. So we haven't paid for them, right? If we bought them on account, that means we're going to pay for them later. So there was no cash in that transaction. And there's no impact to net income because there's only an expense once we use the supplies, right? Until we use them, they're an asset, not an expense. So there's no impact on net income because it doesn't say the supplies were used, just that we purchased them. This next one, we collected legal service fees from clients for current month. Okay, well, if we collected the fees, we got the money. So cash goes up. And we provided the service this month, so that's revenue. And that does increase our net income. The last one says we issued stock in exchange for a note payable. Now, this is a very unusual transaction. Basically, an investor is signing a note that they're going to pay us later, and we're going to give them stock now. Okay. There was no cash in that transaction, right? They just signed a note and we gave them stock, no cash. And there was no revenue and there was no expense. So there's no impact on net income either. Okay, so that's what that one looks like. Any questions on problem number 2? All right, so that matches what we just did. Very good. All right, let's see what's next. We're going to do 4 and 5, then 7 and 11. Okay. For number 4, we have to identify the type. So by type, we're going to say for each of these, does it have to do with accrued revenue, accrued expense, deferred revenue, or deferred expense? And we have to figure out what's the other account that would be involved with this journal entry. Okay, so if there's an account receivable, that means that we provided a service to a customer, so we did the action, and the customer is going to pay us later, so the dollars will come later. So action happened first, that's accrual, and it's related to a sale, so that's revenue. So this is accrued revenue. And the other account that would go together with accounts receivable is sales, or maybe sales revenue, right? Because what it's saying is at the time of the transaction, we would debit accounts receivable, we would credit sales. Okay, so it's an accrued revenue, and the other account is sales. The second one says interest payable. So what that means is that interest has accrued, but it hasn't been paid yet. That would be an accrued expense, right? The dollars are going to happen later. The expense of interest has already happened. So this is an accrued expense. And the other account that goes with interest payable is interest expense. So at the time that we find out how much interest we owe, we can debit interest expense, credit interest payable, and then we'll pay it later. Prepaid insurance. In this case, the dollars happen first, so it's a deferral. And insurance is an expense, so it's a deferred expense. And in fact, insurance expense would be the other account. When we prepay the insurance, that's a debit to prepaid insurance, which is an asset. Oh, let me think. Yeah, that's right. And it would be a credit to cash. But then later, when we do the adjustment, prepaid insurance is going to get credited because it's going down, and then we would debit insurance expense. So the prepaid insurance and the insurance expense go together. The last one, unearned rent. That means we got paid, but we haven't provided the rent yet, right? Haven't provided the property, or at least the tenant hasn't used the property. So because the dollars already got exchanged, we know it's a deferral. Because we're renting it out to somebody, that's a source of revenue. So this is deferred revenue. And once time goes by and they've actually used the property, then we can count it as rent revenue. So unearned rent would go down at that point, and we can credit rent revenue. Any questions on problem number 4? No? All right, let's move on to 5. So impact on the accounting equation of adjustments. All right, this one takes a little thinking. This first adjustment, unearned fees. So we know that's a liability, right? We've been paid for services that we haven't provided yet, right? So we owe that work to the customer. These unearned fees have gone down from 7,000 to 5,000. So because unearned fees are a liability, that liability has decreased, right? So we could say a liability has gone down. What is the other impact on the accounting equation from this event?
Revenue.
The revenue, exactly. We have now earned the fees, which is revenue, and we know that revenue increases equity, right? So we have a liability going down, we have equity going up. They're on the same side of the equal sign in the accounting equation, right? If we think about assets equals liabilities plus equity, we have liability going down, equity going up. So they counter each other, they wash each other out. And so we're still in balance. Okay, then the next one, depreciation expense. Remember, that is a debit to depreciation expense. Expenses reduce equity. And it would be a credit to accumulated depreciation, which is an asset type of account. But remember, when an asset account is credited, that reduces the asset, and accumulated depreciation, that's what it does. It's a contra asset account that reduces our assets. So in this case, we have equity going down from the expense, assets going down from the accumulated depreciation. Any questions on that? Then we've got prepaid insurance going down. So that is an asset that's going down. And then we can also count it as an insurance expense, right? And that reduces equity. Now, the order of these doesn't matter. So if you flip them around, you put equity minus, and equity goes down and assets go down, it's okay. As long as you have both answers there. And the last one, supplies went down. So supplies went down, that's an asset that's decreasing. The other side of that is supplies expense. Expenses reduce equity. All right, so that's what our answers should look like. Let's check that against the answer sheet. Okay. Again, they changed the order, but those are the right answers. Okay. If there are no questions on that one, I think 7 and 11 are our last two problems. Yep, they are. Went a little too far. 7 is actually not hard at all. All right. This says that we need to first make an adjusting journal entry for depreciation. Well, as I mentioned, your depreciation journal entries are always the same. It's always depreciation expense that gets the debit and accumulated depreciation that gets the credit. Okay, so that's all we have to do for that entry. For B, it says we need to determine the net book value of the asset. I think I mentioned this earlier. The way we find the book value is we take the original cost of the asset, subtract the accumulated depreciation, and that gives us the book value. That we need to know because if we sell the asset, we have to determine, did we make a gain that we have to pay taxes for, or did we lose money and that saves us money on taxes? Okay. In this case, the asset had an original cost of $250,000. So we're going to put that here under cost. At the beginning of the year, there was already $80,000 of accumulated depreciation. Okay. But this year, we added another $25,000 of accumulated depreciation. So together, there's now $105,000 of accumulated depreciation. Okay, so we take the beginning plus what we added, that gives us $105,000 of accumulated depreciation. Then we subtract the accumulated depreciation from the net book, from the cost, and we get the net book value. Okay. And that is the amount that if we sell the asset for more than that, it's a gain. If we sell the asset for less than $145,000, then it's a loss. Okay, at least for tax purposes, right? All right, any questions on number 7? All right, well then we'll go on to 11 and then we'll be done. You can go celebrate your Valentine's Day or carry on with the celebrations if you've already started. Okay, number 11. This is actually not too hard. We've got some journal entries and then we've got a T account. So first, the journal entries. It does say here, let me point out, there is a beginning balance of $9,000. So we're going to need that when we do the journal entries. First, when we do the ledger, the T account. Okay. First transaction, April 1st, we paid cash for a 1-year insurance policy. What would we debit? Which account would we debit when we bought the insurance?
Prepaid insurance.
Exactly, Jane. Prepaid insurance. That is an asset that we now own. And we credit cash because that's how we paid for it. So cash went down. Then December 31st, there were $4,500 of unexpired premiums. Okay, so let's figure out how much expired. We started with $18,000. There was $4,500 left over. 13,500 must have expired. So on December 31st, we count that as an insurance expense and we reduce our prepaid insurance. Now let's just double check that to make sure that's the right number. It was $18,000 for a 1-year policy, right? So that's 12 months. If we divide the 18,000 by 12 months, that's $1,500 a month. We got the insurance April 1st. So it covered April, May, June, July, August. I forgot what comes after July. September, October, November, December. Okay, if I did that right, it's 9 months of insurance. And then we've got January, February, March insurance is going to carry over to the next year, right? Those remaining 3 months will be for next year. That works out. 9 months of insurance. So $1,500 per month times 9 months is $13,500. So yes, that works out perfectly. From April through December, we used $13,500 worth of insurance. Okay, so we did our journal entries. Now all we have to do is our T account, which represents the ledger. So at the beginning of the period, there was already a beginning balance of $9,000 in the prepaid insurance account, right? Then we bought $18,000 worth. So we add that, right? This debit to prepaid insurance gets transferred over here to the ledger. So that gives us $27,000 so far of prepaid insurance. But then here, at the end of the year, we realized 13,500 had been used, right? So we credit 13,500. And let's see what our remaining balance is. Again, we started with 9,000. We added 18,000 more that we purchased. We subtracted 13,500 that got used. And that leaves us with 13,500 still remaining. Let's double check that number. Sounds right. But, oops, wrong thing. When things come out that evenly, sometimes that means we goofed. Okay, what are we doing? We are doing number 11. And I goofed. Let's see. What did I do? Oh, I see what I did. I see what I did. I goofed. Okay. So we did, yeah, okay. This unexpired premiums, I was thinking that this applied only to what we had purchased, but this is saying all of our insurance premiums. There were only $4,500 remaining from all of our insurance premiums. Okay, so I did goof that up. Okay, so let's fix it. So at the time where we have to figure out how much insurance got used, we had $9,000 worth, plus we bought $18,000 worth, right? So we actually had $27,000 worth of insurance. And at the end of the year, there was only $4,500 worth remaining. So we had used $22,500 worth. So that's what I should have put here for B. My apologies. Okay. And that also, then this credit here of prepaid insurance is what goes over here. Now, if we find out the remaining balance in prepaid insurance, we take our 9,000 plus 18,000 minus the 22,500 that got used. That leaves us with 4,500. And that is the right number because that is the amount that has not yet expired or not yet been used. Okay. So hopefully that makes sense. we did use that 13,500 that we calculated. I just forgot to include this other 9,000. And if you add those together, the 13,500 that we used from the new policy plus 9,000 that was already there, that's 22,500 total that got used. Okay, so there we go. That's the right answer. That's why I checked my answer sheet to make sure I'm not giving you wrong information. And that's all I had planned for today. We are half an hour ahead of schedule. Does anybody have any questions here before we end the meeting? Okay, remember to work on your personal journal if you want that extra credit, to work on the video #1 discussion, as well as your normal exercise set, problem set, and chapter quiz. Email me if you have any questions. I will tell you this weekend I'm going to be out of town, but I will be checking emails. I just might not be responding quite as quickly as usual. And it is President's Day weekend, so I hope you all enjoy that. And we will be back here next Tuesday with another live session. All right. So until then, happy Valentine's Day and see you later.
Thank you, Mr. Travis, and have a
Okay.
wonderful weekend and enjoy your Valentine's too.
Thank you. Take care. Bye-bye.